Let us revise first all the concepts of risk analysis in capital budgeting, and then we'll be starting some of the questions. So I'm going somewhat fast as far as all the methods that we have covered. Risk analysis in capital budgeting decisions. Which are the methods by which we do it? We also logically understood either the risk will be incorporated in discount rate, or the risk will be incorporated in cash flows, or the risk will be calculated separately. First method were statisticals method, other method were conventional or traditional method, and other methods. Name of methods are not important. It is just to understand an overview of the chapter. Statistical method is probability method, whereby we find out cash flow of a particular year not as a nominal cash flow but an expected value. That is different cash flows multiplied with different probabilities. This is finding out separately which is standard deviation, and the relative measurement is coefficient of variation. So probability, standard deviation, and coefficient of variation are statistical concepts, so they are termed as a statistical method. In traditional method, we have done certainty equivalent, which is the other method in traditional. Yes, risk adjusted discount rate. And as far as others are concerned, it is sensitivity analysis and scenario analysis. This will be taking overall consideration. Normally in scenario analysis, cash flows are adjusted as far as risk is concerned. We are going to solve some of the questions of risk analysis in capital budgeting. We are starting with C6.3. All of you are good to go? Yes. Door Limited is considering an investment of 4 lakhs. This investment is expected to generate substantial cash flow. So cash outflow is 4 lakhs. Over the next 5 years. Unfortunately, the annual cash flow from this investment is uncertain, but the following probability distribution has been established. So the project will be running for 5 years. 1 to 5 years. The probability is 50,000, 1 lakh, 1 lakh 50,000. Probability is 0.3, 0.3, 0.4. At the end of its 5th year life, the investment is expected to have a residual value of 40,000. So this will be an additional cash flow. The cost of capital is 5% required. Calculate NPV under 3 different scenarios. Scenario 1, I am finding out the answers. Scenario 1, if cash flow from 1 to 5 years is 50,000. Also in 5th year, there will be a scrap value of 40,000, which will be coming in. I will be finding out present value at the rate of 5%. So this you can find it out by GT. I will have to use M plus 1 divided by 1.05 is equal to M plus 1, 2, 3, 4, 5. MRC multiplied by 50,000 is the 2,16,473. 2,16,473. And this 40,000 will be present value after 5 years. It is only 1 year cash flow, which is 5th year cash flow, divided by 1.05. 1, 2, 3, 4, 5. It will be 31,341. What will be present value of cash inflow will be total 2,16,473 plus 31,341. 1, which is 247,814. 247,814 minus present value of cash outflow is 4 lakhs rupees. My NPV will be 247,814 minus 4 lakhs. 152,186. 152,186 negative. Which is the scenario 1. If my cash flow is 50,000 every year. Sir, there is a probability attached to it. Yes, but they are first telling me to find out scenario analysis. So as far as scenario analysis is concerned, first answer will be 152,186. Scenario 2. If 1/5 cash flow is 1 lakh rupees and at the end of 5th year I am getting 40,000 rupees. Present value of this will remain same, 31,341. Present value of this 1 lakh rupees. 1 divided by 1.05 is equal to m plus 1, 2, 3, 4, 5 MRC multiplied by 1 lakh. 432,947. 432,947. 432,947 plus 31,341. 464,288. 464,288 is present value of cash inflow minus present value of cash outflow will be 4 lakhs. I will be getting a positive NPV of 64,288 as far as the scenario 1 is concerned. Sorry, scenario 2 is concerned. Scenario 3. If 1/5 cash flow is 1,50,000 and 5th year I am getting scrap value which is 40,000 and present value of which also I am knowing 31,341 because the rate is remaining same, cash flow is remaining same, at the end of 5th year is remaining same. So I just need to find out 1,50,000 rupees. 1 divided by 1.05 is equal to m plus 1, 2, 3, 4, 5 MRC multiplied by 1,50,000. It is 6,49,421. 649,421. 649,421 plus 31,341. 680,762. 680,762 is present value of cash inflow minus present value of cash outflow is 4 lakh. So it will be 2,80,762 positive. This is what scenario analysis. If scenario 1 becomes true, what will be my NPV? If scenario 2 becomes true, what will be my NPN? If scenario 3 becomes 3, what will be my NPV? So then why probability is given? I'll tell you. All right. This is first point. Calculate the NPV under 3 different scenarios. So this is answer number 1. Calculate expected net present value. Now this is probability method, statistical method. This is our answer number 2. What is probability method? First I will be finding out cash flows. What can be my cash flows? 50,000, 1 lakh or 1,50,000. When from 1 to 5 years, what is the probability that my cash flow will be 50,000? Is 0.30. What is the probability that it will be 1 lakh? 0.30. And what is the probability it will be 1,50,000? 0. So this will be 15,000. This will be 30,000. And this will be 60,000. Total will be 1 lakh 5,000 will be my cash flows. Yes, expected cash flow after considering probability, first method. So this is expected cash flows. But for which year? 1 to 5 years, all the years the cash flow remains same. So I will be finding out present value 1 to 5 years. My cash flow is 1,05,000, and in fifth year I am getting scrap value, which is 40,000. See, sometimes the students forgets and ask me this type of question. Sir, why in risk analysis we are not considering depreciation? We should consider depreciation if it is to be considered. See clearly what is written. It is written annual cash flow. They have directly given us cash flow. So we don't need to find out depreciation and other points. We can, but yes, scrap value of the machinery, they have not given any probability. We can directly take that as 40,000. So 1,05,000 discounted at 5%. This present value I am knowing 31,341. 1,05,000 I will be finding out present value. 1 divided by 1.05 is equal to m plus 1, 2, 3, 4, 5. MRC multiplied by 1,05,000. It is 4,54,595. 454,590. 454,595 plus 31,341. 485,936. Present value of cash inflow minus present value of cash outflow, 4 lakhs rupees. Probability plus, NPV plus 85,936. And in probability analysis, you have already considered your risk in cash flow. You are not giving 3 different answers. You are giving only one answer, which is plus 85,936. And you can write down over here, project should be accepted, which you cannot write down in scenario analysis. In scenario analysis, you are just giving the answer that this will be my expected cash flow, expected NPVs. All right, sir, if we have done scenario analysis, can we find out directly this answer? The answer is yes. Please understand, if you get this in examination, you can do it. But otherwise, you can find out by probability method under this. Find out by probability method. I have written so much. Otherwise, you can just find out expected cash flow, find out present value of cash inflow, present value of cash outflow. You will be getting this answer immediately. Or what I can do is, scenario 1 is having an NPV of negative 152,186. Scenario 1, 152,186 negative as NPV. Scenario 2 is having 64,288 positive, and scenario 3 is having 2,80,762. What is the probability that this NPV will happen? 0.30. What is the probability that this NPV will happen? 0.30. And what is the probability that this NPV will happen? 0.40. You can just find out expected NPV. How to find out expected NPV? 152,186 multiplied by 0.30 m minus is equal to 152,186 multiplied by 0.30 is equal to m minus 64,288 multiplied by 0.30 is equal to m plus 280,762 multiplied by 0.40 is equal to m plus MRC 85,935. is nothing but expected NPV, and this two answer will be same. Whatever is the difference, 1 rupee is the difference, is the rounding of difference. But otherwise, these two answers will be same. Here, first I have found out expected cash flow and then found out present value. Here, I have directly found out present value under different scenario and just found out expected net profit value from the NPV of different scenario. Both answers will be same. Please understand this answer number 2 is probability method and answer number 1 is a scenario analysis. Advise Door Limited whether the investment is to be undertaken. So will I give advice based on scenario analysis or probability analysis? Probability analysis. Probability analysis, as NPV is 85,936. I could have found out by this method also. I should accept the project. This is answer number 3. Project should be accepted. As it is having positive NPV, it is earning more than your cost of capital, you should accept the project. This was C 6.3. Second one is 6.2. From following details relating to the project, analyze the sensitivity of the project, a sensitivity analysis question, to the changes in initial project cost, annual cash flow and cost of capital. So you will have to consider this 3 factors for sensitivity analysis. Initial project cost is so and so, annual cash flow is 60 lakhs, project life is 5 years and cost of capital is 10%. To which of the factor the project is most sensitive if the variable is adversely affected by 10%. So they have given even the sensitivity ratio. The cumulative present value, that is all right. We don't require present value factor. Cost of capital is 10%. So at 10%, I'll be finding out cost of capital. All right. Try to concentrate. First, I am finding out my original answer. Then I will be doing sensitivity analysis. Is it all right? So what will be my original? Cost is the 2 crores. Annual cash flow is 60 lakhs from 1 to 5 years. 1 to 5 years. 60 lakhs. Cost of capital is 10%. I will be finding out present value of cash inflow at the rate of 10%. You are having GT, so it is very good for you. 1 divided by 1.1 is equal to M plus 2, 3, 4, 5. MRC multiplied by 60 is equal to 227.45. 227.45 and minus present value of cash outflow is 200 rupees are in lakhs. This will be 27.40. So this is original NPV of the project. Now they are telling me to analyze 3 factors. Also, it should be adversely affected by 10%. Which 3 factors? Initial project cost. So this is sensitivity analysis of variable number 1, which is project cost. Sensitivity analysis of project cost. Project cost if decreases by 10%. No. What is the adverse effect if project cost increases by 10%? Then what would be the cost of the project? It is the 200 lakhs plus 10% will be 210 lakhs. My cash flows from 1 to 5 years will remain same, which is 60 lakhs. So present value of cash inflow will also remain same, which is 227.45. Don't again find it out. You have already found it out over here. Nothing has changed. Minus present value of cash outflow has changed. which is 200 lakhs. So my, sorry, which is 210 lakhs. So my NPV, if project cost increases by 10%, will be 17.45. What is change in NPV? Is it 10 lakhs? How I have found out? 27.45 minus 17.45. So NPV has decreased by 10 lakhs. What is the percentage change in NPV? Is 10 lakh divided by 27.45 lakhs multiplied by 100. Yes. Yes, here there is a mistake. It should be 220 lakhs. Thank you. So this is 220 lakhs. This should be 220 lakhs. This will be 7.45. Change in NPV will be 20. This will be 20 divided by 27.45 multiplied by 100. 20 divided by 27.45 multiplied by 100, which is change in NPV of 72.86%. 72.86%. What does this mean? If project cost increases by 10%, NPV will decrease by 72.86%. Sensitivity analysis of annual cash flow. Sensitivity analysis of cash flow. Then from my 1 to 5 years, cash flow was 60 lakhs. If it is adversely affected, it will decrease by 10%. 60 lakhs minus 10%, which is 54 lakhs. I will be finding out present value of cash inflow at the rate of 10% of 54 lakhs. 1 divided by 1.10 is equal to m plus 1, 2, 3, 4, 1 divided by 1.1 is equal to 1, 2, 3, 4, 5. MRC multiplied by 54, which is 204.70. 204.70 minus present value of cash outflow. 200 or 220, 200. I will now not take this situation. I am going to find out effect on NPV of each and every variable individually. I'm not going to find out in combined manner. So I will be taking this as 200 lakhs. And this will be 4.70, which will be my NPV. Change in NPV will be 27.45, which was my original NPV, minus 4.70, which is my new NPV, which will be 22.75. In terms of percentage, it will be 22.75 divided by 27.45 multiplied by 100. 22.75 divided by 27.45 multiplied by 100. 82.88. If cash flow decreases by 10%, my NPV will decrease by 82.88%. This is what does it mean. So it is measuring sensitivity. Last is cost of capital. If my cost of capital decreases by 10%, no, cost increases, then it is an adverse effect. So last, sensitivity analysis on KO. If cost of capital increases by 10%, so 10 plus 10% is 11. Find out present value of cash inflow of 60 lakhs for 1 to 5 years. At 11%, 1 divided by 1.11 is equal to m plus 1, 2, 3, 4, 5. MRC multiplied by 60. 2 to 1.75. 2 to 1.70 minus 200 lakhs. This will be NPV, which is positive 21.75. What is change in NPV? 27.45 minus 21.75. 5.7. Percentage change in NPV 5.7 divided by 27.45 multiplied by 100. 5.7 divided by 27.45 multiplied by, which is only 20%. So if my cost of capital increases by 10%, my NPV will decrease only by 20%. Comparatively, out of project cost, cash flow and cost of capital, which variable is more sensitive to the project? Which variable? Project cost. No. Cash flow is most sensitive to the project. Why? If cash flow decreases by 10%, NPV is decreasing by 82.88%, means this is the most sensitive variable. This is also what they have asked. The project, to which of this factor the project is more sensitive? The project is more sensitive to cash flow. You need to write down a statement below your answer. Project is most sensitive to cash flows by 82.88%. I'm going to see 6.6. Again, in scenario analysis, Kanoria Enterprise wishes to evaluate two mutually exclusive projects X and Y. Initial investment 1,20,000. Estimated cash inflow for 8 years. Pessimistic 26,000. Most likely 28,000 and optimistic 36,000. The cutoff rate is 14%. What is the, see, another name of required rate of return? Cutoff rate. What is cutoff rate? I am ready to accept the project only if the project is earning a cutoff rate of 14%. That is my minimum required rate of return, below which I don't accept the project, above which I accept the project. So it is known as cutoff rate. The discount factor are as follows. So discount factor are given. I am first calculating of X, and believe me, here you cannot do probability analysis. Here you will have to do scenario analysis. What will be scenario analysis? Please try to understand. I am doing first of project X. If I treat pessimistic estimate only, then from 1 to 8 years my cash flow will be 26,000. What will be present value of cash inflow at the rate of 14%? 1 divided by 1.14 is equal to 8 times GT multiplied by 26,000. 1 divided by 1.14 is equal to m plus 1, 2, 3, 4, 5, 6, 7, 8. MRC multiplied by 26,000, which is 120,610. minus present value of cash outflow 1,20,000 plus 610. You need to do it for most likely also. If the most likely outcomes appears from 1 to 8 years, your cash flow will be 28,000. Present value of cash inflow at the rate of 14%. Let me find out the factor if they have not given. Yes, I will be finding out factor so that it becomes easy for me. 1 divided by 1.14 is equal to m plus 1, 2, 3, 4, 5, 6, 7, 8. MRC. It is 4.639. 4.639 is the factor, so that I can use every time and just multiply it. 28,000 into 4.639. 129,892 minus 1,20,000 9,892 positive. Project X optimistic result 1 to 8 years, then cash flow will be 36,000. Present value of cash inflow at the rate of 14% will be 36,000 into 4.639, 167,004 minus present value of cash outflow is 1,20,000. This will be 47,000. This is for X. I need to also do it for Y, which is having a same project cost but different scenario. So pessimistic, most likely, and optimistic for project Y. Here the cash flow for 1 to 8 years will be 12,000. 1 to 8 years will be 12,000 multiplied by 4.639. I have found out the factor, present value annuity factor. 12,000 into 4.639, 55,668 minus present value of cash outflow 1,20,000, 55,668 minus 1,20,000, 64,332 negative. If it is most likely, it is 28,000 multiplied by 4.639, 129,892 minus 1,20,000, 989. Optimistic 1 to 8 years cash flow will be 52,000 multiplied by 4.639, 52,000 multiplied by 4.639, 241,228 minus present value of cash outflow 1,20,000, positive NPV of 241,928, 41,228 minus 1,20,000, 121,228. This is present value of cash outflow. This is nothing but scenario analysis. This is where the difficult part comes in. Advise management about the acceptability of project X and Y. And please understand, they are mutually exclusive. What does this mean? You can select project X or you can select project Y. We have understood variability in return is nothing but risk. Which project is more risky? Can anyone tell me? Project X or project Y? Instead of return, you can compare NPV. Is there chances to incur negative NPV in project X? Is there chances of having negative NPV in project Y? Yes, project Y is more risky. You can just see that standard deviation of project Y will be higher than standard deviation of project X. You can just see it. See the middle cash flow. This is 28,000. This is 28,000. Here the minimum is 12,000. Here the minimum is 26,000. Here the highest is 52. Here the highest is 36. All right. So X and Y is more risky, X is less risky. If you are a pessimist person, if you are a less risk aver person, you should go for project X. Otherwise, the management should go for project Y. Is it all right? In my suggestions to management, project Y is having more risk and expectation of earning higher NPV. So, risk averse management should go for project Y. However, conservative management should go for project. You can write down in your own language, but it should make sense, right? You just found out that project Y is more risky. Just include in your suggestion that project Y is more risky, X is less risky. But when you take more risk, there will be an expectation to get higher NPV, which is 1,21,000. Here the highest NPV is 47,000. So higher the risk, higher the reward. Tell to your management, if you want to take the risk, you may go for Y. Otherwise, you may go for X. Both are having positive NPV in some of the scenarios. So you may suggest sometimes X also. X is only earning 610. Why to conservative person you are telling to accept project X? Because it is covering your required rate of return. You are at least earning your required rate of return. Over and above, you will be earning this amount. This was 6.6. See, the answers in risk analysis in capital budgeting will be normally easy. It will not be much difficult. We are going to 6.8. is same as 6.4. First question. It is exactly same. No, exactly same as 6.3. And 6.5 is the same as 6.2. Exactly. Along with the figures, it is same. Just it is repeated by mistake 2 times. We are going to 6.9. There are 13 questions up till 6.9, out of which 2 are repeated, means 7 questions we are going to do in classwork, other questions we will be doing it in homework. This is C 6.9. A Limited is considering two mutually exclusive project X and Y. You have been given below the net cash flows probability distribution of each project. Project X, Project Y. You are required to compute expected net cash flow of each project. Expected value, average is one and the same. Variance of each project, standard deviation of each project, coefficient of variance of each project. And then you need to identify which project do you recommend. Only cash flows are given and they are telling us to give recommendation. We will try it out. I am first doing it of project X. My cash flows are 50,000, 60,000 and 70,000 with a probability of 0.30, 0.30, 0.40. My expected value, it is expected value of X. Symbolically it is written as this, or it is X bar. It is the sigma xi pi, just multiplication of this three. So 50,000 into 0.3 is equal to m plus, 60,000 into 0.3 is equal to m plus, and 70,000 into 0.4 is equal to m plus. MRC is 61,000. 61,000 rupees cash flow is my average. Expected net cash outflow of each project. So this is answer number A. Variance of each project. How to find out variance? Variance is standard deviation square. I will be using this formula, sigma x minus x bar whole square into P. Sir, why not under root? Because it is variance and not standard deviation. I will be directly finding out in my calculator sigma x minus x bar whole square into P. If you don't understand, try to concentrate. 50,000 x minus 61,000 x bar into is equal to square multiplied by 0.30 is equal to m plus. It is coming a huge answer, yes. 60,000 minus 61,000 multiplied by is equal to multiplied by 0.30 is equal to m plus. 70,000 minus 61,000 multiplied by is equal to multiplied by 0.4 is equal to m plus. MRC is 6 crore 90 lakhs. And this is my answer of variance, 6 crore 90 lakhs, which is my B answer. Standard deviation, C answer. Standard deviation is under root variance. So it is under root 6 crore 90 lakhs. It is 6 crore 90 lakhs. So 6 crore 90, that is 690 lakhs under root. This 26 lakh 26,785. Let me do it. 6 crore 90 lakhs is variance, right? So 6 crore 90 lakhs. 8306.62 is a standard deviation of this project. D. Coefficient of variance. Coefficient of variance is nothing but standard deviation divided by x bar, which is 8306.62 divided by x bar is 61,000, which will be equal to 8306.62 divided by 61,000, 0.1362. This I have done of project X. I will have to repeat it for project Y. One 30, 110, 90. This is Y. Probability is 0.2, 0.3, 0.5. Y bar or expected value or answer A, 1,30,000 into 0.2 is equal to M plus 1,10,000 into 0.3 is equal to M plus 90,000 into 0.5 is equal to M plus. MRC is 1,04,000. I will be finding out variance by sigma x minus x bar whole square into P. So it will be 1,30,000 minus 1,04,000 into is equal to multiplied by 0.2 is equal to M plus 1,10,000 minus 1,04,000 multiplied by is equal to multiplied by 0.3 is equal to M plus 90,000 minus 1,04,000 multiplied by is equal to multiplied by 0.5 is equal to M plus. MRC is 24 crore 40 lakhs. 24 crore 40 rupees, which is nothing but variance, which I have found out by sigma x minus x bar whole square into P. Standard deviation under root 24 crore 40 lakhs. So 24 crore 40 lakhs under root 15,620. And coefficient of variance, standard deviation upon y bar, 15,620 divided by 1,04,000. (0.1502). I'm just making a comparative presentation of X and Y. Standard deviation of X is 8306 and standard deviation of Y is 15,620. So if you just watch this figure, let me write down 8307 approximately. If you compare these two figures, you will feel that project Y is more risky. Now here we are only measuring risk. We are not measuring any return. But if you see coefficient of variance, this will be 0.1502 and this will be 0.1362. 0.1362. As far as the total risk is concerned, project X is less risky. As far as coefficient of variation is concerned, project X is less risky. You should select a project which is less risky. Please try to understand, whenever you give advice to management, be very careful what you are writing it down. Don't advise management to take project X. Advise this. Advice to project X is less risky as compared to project Y. Your advice should be absolutely correct. That does not mean you will be selecting project Y. You will have to still see the cost of project Y. You will have to see other variables of project Y. Yes, by these two figures you can determine that, you can determine that project X is less risky as compared to project Y. This gives you idea of total risk. This gives you idea of comparative risk to your cash flow. I'll tell you what is 0.13. In project X, there is a 0.13 risk for every 1 rupee of cash flow. In project Y, there is 0.15 risk for every 1 rupee of cash flow. If you want to find it out in percentage, you can multiply this by 100. But no need to do it. You can directly compare it with 1. Is it all right? So compare these two figures and you will be getting an answer which project is more risky. We are incorporating risk into capital budgeting, and this is nothing but incorporation of risk into capital budgeting. We have not incorporated actually, we have found out separately. This is measurement of, and see my advice also, it is absolutely logical. Project X is less risky as compared to project Y. That's it. And the advice, don't advise to take up project